Hello and welcome to Project Trade. This is the Technical Indicators Show. And it's an easy one today, but there's still quite a bit to talk about. It's the simple moving average, arguably the most basic technical indicator in all of trading. Where does it come from? Well, it's based on arithmetic mean, so it has been around for a while. Some are going to point to ancient Babylonian astronomers or Greek mathematicians such as Pythagoras or Hipparchus. But either way, it is a very old method of determining an average value, starting to find use between around 500 and 100 BC. Now, obviously, these weren't the first guys to plug it into a stock chart and start trading, but the discovery of the concept can be owed to them. The simple moving average is one of many moving averages. There really is a lot of them out there, and they're all trying to do similar things to one another. So what is that main thing that they're all trying to do? It's that based on previous prices, they're attempting to assess what the recent price trend has been so that you can know what the current price trend is, and more importantly, you can then use that to try and predict the future trend, which is all we want, right? To be able to tell the future. Not a lot to ask. How far it looks back, that is up to you, as your platform should offer you an input for the number of periods you want, and you can choose up to almost any number you would like. The limit will vary between platforms, but most are going to offer you at least a 1000 period input for those of you with an incredibly long-term mindset. And here's that mean formula for the PhD mathematicians listening. So it's adding together each period as far back as the input goes, and then dividing that total by the number of periods. It's then going to plot the result as a data point on the chart, connecting it with a line to the previous data point. But a picture is worth exactly 1000 words, so let's do a quick and fun-filled guided tour of some moving averages. There's a 5-period moving average, a 14, that's a 50, and when you look at that, there's a 200 over there. Okay, fun's over, let's get back to the good stuff. Now, between traders, there will forever be an ongoing debate regarding a preference of input periods, whether a slow or fast moving average is better. As a general rule, the slower moving averages will drift further from the price, especially in a hastening trend. Here's a comparison between a particularly fast and a particularly slow moving average, and you can see how far the 200 diverges from the price compared to the 14 moving average, especially as that uptrend really starts to take off. The benefit of a fast moving average is that it will get you into the trends quicker, so that when a trend does stick, you will have been in on it early, and hopefully you'll be able to maximize your gains. But that quicker average will also give you a lot more false signals when the trend doesn't stick and price actually carries on in a range. That means you're likely to take more losses from the dodgy signals that will come from the faster average. Whereas that slower moving average will give you less false signals, but when price does eventually trend, you might have missed a good chunk of the move already before the average even responds. The struggle continues. Also, it doesn't just have to be one moving average that you're using. You can crank that number to whatever you like and do any number of comparisons. How many do you need? 3, 6, 42. I like this one. We've even got a 1-period moving average that does track the price there to the close. That's the yellow line. No, try not to do it. If you have any more than 3 moving averages on your chart, it is fair to start asking yourself the question as to whether those extra lines are actually giving you more information that you don't have, or whether they're just clogging up your chart. Whether you use a slow or a fast moving average, 1 moving average, or 10 of them, it's likely going to depend on what other factors you're incorporating with your strategy and your own personal trading style. If there was any single simple moving average that could consistently make money, then everyone would trade all the time. And I don't know about you, but I don't see everyone trading all the time. Now, when you're applying the simple moving average, your platform should also give you a choice of the source price that you would like the indicator to apply to. The default is often the close of the price. I would say any of them are fine except for the high and the low, which can provide more outlier results. So unless you're targeting that, it's probably better to stick with something more consistent. Aside from that, the only other input you might get the chance to change, apart from the color, is the shift input. All this does is shift the indicator forward on your chart. So you can see here that a shift of 5 on the darker blue line pushes that indicator 5 periods past the indicator without any shift on it. Good stuff. So now we understand how the indicator works. What entry signals can we get out of it for our trading? The simplest thing you can look for is whether your moving average is sloping up or down. Assuming that you are using this as a trend indicator and you are looking to open a trade, well, you could open a buy trade if the moving average is in an upward move, or if the slope is downward, then you could enter a sell trade. Next, we could enter a trade when the price closes above or below the moving average. On the left of this chart, where price closes above our moving average, we can assume that an uptrend has begun and therefore enter a buy trade. Or where it crosses below on the right-hand side, that is when we would enter our sell trade. Or we could enter a trade when the price bounces off of the moving average. So for example, in an overall uptrend, if price doesn't break below the moving average on a retracement, but instead it bounces off of it, that's when you would enter a buy trade. And the same but in reverse for a sell trade. As you can tell, this is more of a re-entry signal on an existing trend. We can see here in this uptrend that there's a couple of areas where the price has bounced off that moving average. So at that point, that is where we would enter our buy trade like Dr. Cool and catch the rest of that smooth trend. We could also use two simple moving averages as a strategy for a moving average crossover. This involves having a fast moving average and a slower moving average. The input doesn't matter just as long as one average is faster than the other. And when the faster line crosses the slower line, that's when you would enter the trade. Here we have the lighter aqua line playing the role of the faster moving average, and the darker blue casts as the slower. When that faster average crosses under the slower average, it is time to sell, and when it moves back above it, that's when it is our time to buy. But just stop for a second and think about these entry signals we've mentioned so far. Imagine taking every signal for one of these every time. You are going to be financially ruined very quickly. If you just remortgage your family home so that you could take all of those signals to win big and retire early, then you are probably in Tearsville right about now with a pending divorce and a court order for child support. And I'm going to give you some very blunt honesty. There is very little that I can do to help you apart from to simply wish you luck. But for the 99.99% of listeners who are not in that person's position, you have been warned of the consequences for taking every signal from a moving average every time, or taking any of these signals without consideration to other market or technical factors. With that in mind, one final part of how the simple moving average can be used to give you signals is you can merely use it as a filter for your other indicators. For example, a very common use of the indicator is to say, okay, if price is above the moving average, then I'm only going to enter buy trades when I look at my second or third entry indicators, and when it's below the moving average, I'm only going to take sell trades from those indicators. If you are chasing trends, this may be a good way to filter out those retracements and other false signals that don't belong with the overall trend. Enough with our entry signals, let's see how the simple moving average can help us with money management. To start with, you could decide to exit your trade because the moving average has turned against you, indicating that the trend you were after may be over. Or if price closes across the moving average from the direction of your trade. For example, if you were in a buy trade and the price closed below the average, that's when you would exit. And if I mentioned closing your trade due to a moving average crossover, you can see that these are simply taking a lot of those typical entry signals we just talked about, and we're reversing them into exit signals. Another useful tool in money management is the trailing stop loss, and you can use one of these with a simple moving average guiding where you place the stop. If you're in a buy trade, you could place the stop loss just beneath the moving average value, and if the trend continues, then you would move that stop loss with the moving average. Once we get into the markets, the simple moving average is similar across assets. That includes forex, stocks, cryptos, metals. It is going to be as consistent or inconsistent in all of them. Something that is said to watch out for is that there are certain times where the moving average may be thrown off by a particular event trigger. For example, increased volatility on a currency at the release of economic numbers that relate to that currency, or at the open of a stock market. Those type of things can cause the moving average to be very unsettled for a short period of time. Also, where the asset price may have jumped up or dropped down during the time out of market hours, there could be a significant gap, so the moving average might need a period of time to catch up, or you may want to set the input of your average so that it doesn't include the gap. Fortunately, a lot of the news events and market opening times are fixed into the calendar, so you can prepare yourself in advance of them. And just remember that in any market, a lagging trend indicator like the simple moving average will get destroyed in a rain. And although I have given a lot of time to how the indicator works in a cherry-picked trending environment, I'm about to show you a bloodbath, so avert your eyes if you are sensitive to losses. Here's a chart where we could take some entries from a moving average crossover. It's a 14 and a 50 period moving average, so we're entering when the aqua line crosses the darker blue line. We'd first get a sell trade basically at the bottom of the market before price launches upwards. Terrible. We'd then have to avoid that near crossover in the middle there, make sure we didn't enter that one, before finally entering a buy trade right at the peak before price plummets back down, leading us into another sell trade at the bottom of the market again, only for it to come back up. And over on the right, we've got a double crossover where price is already headed back down when you get into the buy trade, so you immediately have to re-enter into a sell trade. This is destructive action with almost the worst entries every single time. So if you feel like the simple moving average misses the mark but only by a touch, there are many other similar moving averages available. Far too many for me to list them all here, of course, but some of the more popular ones include the exponential average, the linear weighted, the smoothed. If you are finding that the simple moving average is giving you too slow of a signal because of the way it treats old data as the equal of new data, something like the exponential or linear weighted may be preferable for your trading style, as they are giving more recent data more weighting. The simple moving average is also relevant enough to be included in the formulas of other technical indicators. A couple examples would include the Bollinger Bands, which typically uses a 20-period simple moving average with volatility measuring lines on either side of it, and you've also got the Envelopes indicator, which plots a moving average both above and below the price. If you want something calculated a little differently to the moving average, you could take a look at a couple of lines on the Ichimoku Kinko Hyo indicator. The Tenkan Sen and Kijun Sen lines both look back at a range of candles. They take the highest high and the lowest low from the price in that range and divide it by 2, giving you average lines which look like this. I've removed the cloud and the Chiku span from the Ichi indicator, so all that's left is just the Tenkan Sen line at 9 periods and the slower Kijun Sen line at 26 periods. These can be used individually or as a crossover, and they're generally giving you the same signals as what a moving average will. You're also free to change the input of those lines if you want something quicker or slower, and you can tell from how they're presented on a chart why these lines can be considered a substitute for moving averages. It just gives you a flexible alternative to them. In conclusion, it's the simple moving average for the simple people. I like to use it from time to time, and it undoubtedly has its uses in technical trading. Always has and always will. It's giving you entry signals in the form of slopes and crossovers, and giving you exit signals in the reverse. It's got great versatility at fitting itself into numerous other strategies to help try and filter out their false signals. But remember, if you're trading with this one and you do get stuck in a range, more often than not, you are going head first into the meat grinder. These lagging trend indicators will get crushed in a range, so if you do have a method to help you avoid the ranges and find more trends, I'd recommend using it. That's the end for the simple moving average, but it could just be the beginning. If you are planning on writing a book or a doctoral thesis on this indicator, there are many more uses for this one in trading. This is just a sample, so do get on out there and keep researching. If you do want more information, there will be links in the video description. It's all just a puzzle, you've only got to find the right pieces. And word of warning that every single chart in this video has been pre-selected specifically for showing you how the indicator may or may not work. Don't go thinking that the market does nothing but trend. Fortunately, I have used this indicator in live forward testing strategies and will also link those videos in the description. This is Project Trade and we are the traders of the Lost Chart. Thank you for watching.